Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank using the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarah Ibrahim. I have with us today a very special guest. His name is Jay Connor. He's a real estate investor and he's been buying and selling houses since 2003 in a population of only 40,000 with profits averaging $67,000. He's rehabbed over 400 houses and has been involved in over $52 million in real estate transactions. For the past 7 years, Jay has completely automated his seven-figure real estate business to where he works less than 10 hours per week in his business. He's consulted over 2,000 real estate investors on one-on-one. He's known as a private money authority. He's raised $2.1 million in private money in less than 90 days when the banks refused to loan him a dime. He's a national speaker on topics of private money, business automation, automating your real estate business, and foreclosures. He's also the best-selling author of Where to Get the Money Now. Stay till the end of the podcast, and he'll send you a free copy of that book. He's a leading expert on private lending, marketing, and business development. Jay, I'm so happy you're with us today. Welcome to the show.
Well, hey there, Sari. I'm so excited to be here to talk about my favorite subject, private money and private lending. Yeah, thank you for inviting me to come on.
Yeah, thank you. And I love the topic you specialize in because I think it's consistent with our show. Like making money, especially real estate, doesn't always have to be you going out and actually doing the work, actively investing, even though that is very lucrative in itself. There's also a whole nother dynamic to real estate, and that is the private money lending side. Whether it's you're the private money lender, and then also the alternative of going to private money lenders instead of going to banks. And there are specific reasons for that. Before we jump into all that fun stuff, tell us more about your background and how you got into private money lending.
Sure. Well, my wife, Carol Joy, and I live here in Eastern North Carolina in a little teeny tiny town called Morehead City, North Carolina. Has a whopping population of 8,000 people. But yeah, we started investing in single family houses way back in 2003. And Sari, from 2003 until 2009,
Mhm.
we relied on local banks, traditional mortgage companies, institutional lenders to fund our real estate deals. So that was going great for 6 years. But then come along in January 2009, I picked up my telephone and I called my banker that I'd been doing business with for 6 years. I told him about two deals that I had under contract that needed funding. And I learned very quickly on that telephone conversation that my lines of credit were gone. Like I had no way to fund these deals. My first thought was, I sure wish I'd known that before I put down earnest money. Back then in 2009, you couldn't get your earnest money back. And so I had a fantastic credit score. I wasn't being cut off from the bank because of a bad relationship with the bank. I learned that the rest of the world, the rest of the real estate investors on the planet were being cut off. And it was a global financial crisis, as I'm sure many of your audience members and listeners recall. So I hung up the phone, didn't have any way to fund my deals. And I called a buddy of mine whose name is Jeff. He lived in Greensboro, North Carolina at the time. He was a real estate investor. I told him what had happened. I said, Jeff, the banks just cut me off. I don't have any way to fund my deals. He said, welcome to the club. They just cut me off last week. I said, what are we going to do? Well, he had heard about private money. I had never heard about private money. I'd never heard about self-directed IRAs or anything like that. And so I learned about private money. I put my private money lending program together and I was able to raise over $2 million in less than 90 days. And Sari, I'll tell you, I have yet to miss out on a deal since that conversation in 2009 for not having funding for deals. In fact, I've got money sitting on the shelf right now. Carol Joy and I, we've got about 47 private lenders that fund our deals, loan money to us on real estate. And they're from all over the nation. We got them in like 10 different states. And I tell you, it was a huge blessing in disguise to actually go through that difficulty, because back then, all these properties were coming available.
Mhm.
And I had the cash available right there to buy these properties. In fact, when I lost my line of credit at the bank, I only had $1 million line of credit. Well, my lands, the banks did me a favor by shutting down my lines of credit because I doubled that in a very short period of time. Now we have about $8 million that we churn from, house and project to project. So yeah, it was a huge blessing to go through that. In fact, if I hadn't gone through that experience, you and I wouldn't be on your podcast today.
That's wonderful. That's awesome, Jay. I love it. Yeah. And, it kind of as you were talking, I was thinking of Mark Twain's quote: a banker is a fellow who will loan you his umbrella when the sun is shining, but wants it back the second it starts raining.
I don't ever remember going or hearing that from Mark Twain, but it's so true.
Yeah. So like banks, in other words, when everything was fine, they were loaning money. But once things started tightening up after 2008, 2009, everybody got their lines of credit cut. Even people who had, like, I was talking to one of my clients, and he said that he had like 3 credit cards with American Express, and then one of them cut his limit down from 100,000 down to like 20,000, and then as a result of that, it shot his credit from like 700 down to like 550, and then the other 2 credit cards were called, and then his mortgage, and then everything else was just like a domino effect after that, because the banks are ultimately in control of these things. Now, in very basic terms, what is private money lending?
I'm glad you asked, because a lot of real estate investors and people have got a misconception that private money is the same as hard money.
Yeah.
And hard money is not private money. So, hard money is a broker of money that is institutional money.
Yes.
That typically goes out and raises private money from individuals and then, loans it out to real estate investors. Well, a private lender is an individual, a human being,
yes,
that loans out their money from either their investment capital or their retirement accounts by converting those into a self-directed IRA. Then they loan the money to us real estate investors. So we're doing business with people. This is called mom and pop money by some people. And what's beautiful about a lot of the deals that we do is we set the rules. Like when we're borrowing money from private lenders, what I call from our warm market, people that we have some kind of relationship with them, then we actually taught them and teach them how to be a private lender. If they've got retirement funds, we introduce them to our self-directed IRA company that we do business with.
Gotcha. Okay, that makes sense. Yeah. And the difference is, like, for example, like if a bank has a set of requirements, like they say, for example, they can only loan out to properties between 200,000 and 400,000. A private money lender could make that determination if they want to or not. Like they don't have any corporate rules or corporate underwriting. They might have their own criteria, but they make those criteria. And that's beneficial to the real estate investor because they don't have to rely on banks, whether they'll accept the offers or whether they'll loan the money or not. Typically, banks don't usually loan out to properties that need rehab and situations like that, which is the advantage. Also, I think it's much faster, right, to go through private money lending than to go through traditional banking.
Yeah, that's one of the many reasons that I love private money is that you can close deals super fast. In fact, on my offers to sellers, we're able to literally close deals from the time we go into contract within 7 days.
Yeah.
Well, my lands, I mean, a hard money lender or a traditional lender, the quickest they're going to move is maybe 3 weeks, 4 weeks, or even a traditional lender, 45 days.
Yes.
And, that's one reason we get more offers accepted from motivated sellers is because we're able to close deals using our private money lenders so fast.
Yeah, exactly. I think once the sellers hear private money, they might associate that with cash buyers. In other words, there's cash behind somebody that's readily available. Right.
That's right. That's right. So, and another thing about private money, I say every private money deal you do is actually a no money down deal.
Yeah.
Here's what I mean by that. No money down out of your own pocket as the real estate investor. In fact, we always borrow more than we need to purchase. And if rehab's involved, more than we need to rehab, because that way we get to bring home a check every time we buy a property. I mean, who wants to get paid to buy properties and not have to put any of your own money down?
Yeah, it's wonderful how you could do that. Now, I think, one downside to private money lending is like interest rates are typically 10%, 14%, right around that range. How do you justify that? How do you justify paying 10 to 14% to borrow money?
Well, I pay my private lenders 8%.
Okay.
Yeah. So I don't pay 12% or 14%. That's hard money rates to me. It's when I'm
Okay.
borrowing money from people that I've taught what private is, the beautiful thing is we get to set the rules,
Yeah.
right?
Yeah.
So I don't pay any origination fees.
Mhm.
But really, to your point, Sari, having access and quick access to the money is actually more important than the interest rate that you pay.
Exactly, because what if you have this property and then you're so hung up on the interest rates and you lose the whole property? Now you potentially lost 50 or $60,000 because you were worried about 2% or 3%. The differences between that.
Exactly. Having the access is the most important. And not only access, but quick access. I mean, in this world of private money, there's never any appraisals
Yeah.
that's required by the private lenders that we do business with. And in fact, I never pitch a deal. I
Yeah.
never pitch a deal. It's like, and the reason I don't is because first we have the private lenders excited about the private lending program. And then I come back to them with a deal. And when I come back to them with a deal, I don't ask them if they want to do the deal. That's the most stupid question I could ask. I mean, of course they want to do the deal. They're
Yeah.
waiting for the phone call. In fact, Sari, when I've got a deal for one of my private lenders to fund, I call them up and I only tell them four things.
Mhm.
And the first thing I tell them is, hey, I got great news. I can now put your money to work for you
Mhm.
on this next deal. And here's what I tell them. The property's located in whatever township. What's the after repaired value?
Mhm.
What's the money needed required to fund the deal? And the date of closing, which is the date they need to wire their funds. That's it. And after we do one or two deals, the only thing they want to know is how much do you need and when.
Mhm. And I love how you said that. Like, I have a deal for you. I have an opportunity for you, because from the investor standpoint, from the private money lender standpoint, let's say they have $100,000 in the bank. That's worse for them. They want that money moving. They don't want it sitting in the bank, missing out on inflation and the loss of opportunity cost. They want that money moving with you at 8%, and then keep turning that money over and over. So you finding these deals and going to them is actually, it's also an opportunity for them. A lot of people think about it as just one way, is like, this person's going to loan me money, so this is going to be tough. Well, actually, if you understand both sides, you're doing them a favor as well by moving their money and giving them a higher rate of return.
Absolutely. I mean, doing private money the way that you and I do it is we're not begging, we're not
Yeah.
chasing, we're not selling. We are actually doing them a big service
Yeah.
by even letting them know about what private money is and what private lending is.
You're doing more for them than Wall Street is. Like, really, like, putting the money in the stock market, it's super volatile. Who knows what's going to happen? It's not very liquid. You have to sell your stocks in order to get your money out. But as with real estate and private money lending, typically, I think, in my opinion, in my professional opinion, I think you can get a higher rate of return in private money lending than you could investing in the stock market.
Oh, yes, for sure.
Yeah.
Well, you know exactly what your return's going to be as
Yeah.
the lender,
Yes.
and you don't have to worry about your investment amount losing value.
Yes.
I mean, people that invest in the stock market, they already lost money because there's fees and there's commissions. And of course, we tell our private lenders when they're new, there's no fees, there's no commissions, nothing comes out of your investment amount. You know
Yeah.
exactly what your rate of return is going to be. And what you just said, Sari, reminds me of this. I mean, did you know, you probably know, Sari, I don't know about your audience, but every Thursday,
Mhm.
USA Today newspaper publishes on the front page of the money section the average yields from certificates of deposit at the local bank. Did you know last week, the average yield on a 12-month certificate of deposit in the local bank is 0.17%. That's less than 0.25%.
Yes.
By putting your money in the local bank. I tell people all the time, real estate investors, I say, look, people don't know where to put their money, and it's our moral and legal and ethical responsibility to show them where they can put it.
Yeah. Absolutely.
I mean, they got a
Yeah.
problem.
Yeah.
They got a problem, and we got a solution to their problem.
It's a wonderful thing what they could do with it, because it's definitely gonna do more for them than the bank could. And I mean, I don't want to say it's safe, but it's definitely safer than other forms of investments, because It's a loan, right? It's not a you're saying I'm going to give you X amount of dollars, you're going to pay me back 8%. That's the agreed upon rate. Technically it's guaranteed they have to pay that back to you. Now what happens, there could be risk involved with that. But I want to go back to one thing about access, the access to the capital you said. So part of the bank on yourself concept, what we specialize in, and we talked about this on your show, is the ability to tap into cash whenever you want, in as little as like 3 to 5 business days. So I think that a lot of our clients are also private money lenders, people who have bank on yourself type of life insurance policies, because they could tap into it anytime. Also, the growth of the policy and the ability to access is not affected by market conditions. So in 2009, when banks stopped loaning out money, insurance companies were still giving out loans for people who had life insurance policy. So I just wanted to put that out there because you can connect those together. You could have your cash sitting in a life insurance policy earning you 4 to 6% instead of 0.017%. You can have it earning 4 to 6%, tap into it, borrow against it, loan it out at a higher interest rate, and then pay yourself back and then keep it growing over time. I just wanted to add that piece in.
Absolutely.
Yeah. So walk us through an example. So let's say, for example, it's today is October 6th. I come to you, Jay. I need a $100,000 to buy a property. Walk us through that process of you give me 100,000, I buy the property. When do I pay you back, and how does the payment structure look when I pay you back?
Sure. So the one beautiful thing about how often a private lender will get payments, the way I do the business is so a private lender is going to be loaning us real estate investors money primarily from two different sources, not including the whole life insurance policy. One is just their investment capital that's liquid, and then they can be using retirement accounts. Well, if they have an existing retirement account, they can roll that over to a IRS approved third-party custodian, self-directed IRA, and then loan that out either tax deferred or tax free. So as far as the frequency of payments go, the way I work it is if they're loaning, if the private lender is loaning money from their retirement funds by using a self-directed IRA, then we're typically going to make those payments back to their retirement account either quarterly or semi-annually.
Okay.
But if they are, or when we cash out on the deal, because the reason for that is the money or their interest that they're earning is not coming back directly to them. It is going into their retirement account. On the other hand, if a private lender is loaning us money on a deal and they're just using investment capital, they're just using liquid funds, then quite frankly, we leave it up to the private lender to what their objectives are. For example, I've got quite a few elderly private lenders just using investment capital, and they don't want to touch their principal investment amount. They just want to earn a return on it and use it as income. So for those private lenders, we'll pay monthly. Some will pay quarterly, and it all comes down to what their objective is. Now, as far as the length of the note, typically the length of our notes are going to be 2 years, because typically within 2 years, we're going to be cashing out on a property within 2 years of us buying it. Even if we sell it on rent to own or lease option, we're probably going to be cashing out within 2 years. So length of notes, 2 years. Also, we give our private lenders what's called a 90-day call option. So if they have some kind of emergency come up and they need their investment amount, their loan amount back early prior to the note coming due, then they just need to give us a 90-day notice. That gives us plenty of time to replace their loan amount with another one of our private lenders' money. So again, length of the note, 2 years, but we can pay off early with no penalty to the private lender. Frequency of payments is left up to them. Now, we typically are not going to borrow more, and this is how we mitigate the risk for the lender. We typically do not borrow more than 75% of the after repaired value. So that gives a 25% equity cushion for the lender. So let me go ahead and answer the question. Well, how can you bring home a big check if you're only borrowing 75% of the after repaired value? I didn't say borrow 75% of purchase price. I said borrow 75% of after repaired value. So when there's a major rehab involved, we buy properties all the time around 50% of the after repaired value. Well, that leaves a big chunk that we can borrow above purchase price and include rehab money to where they end up with that equity cushion after the house is rehabbed.
Got it. So if a property is worth $100,000, right, and you buy it for 50,000, and is it so let me just better understand that. So the difference between after repair value and the purchase price.
Sure. So let me give you a example. Let's say that we're buying a house using private money, and the after repaired value is after repaired value is 200,000.
Yes.
200,000 of the after repaired value. Well, if I buy, and let's say it's a major rehab, I say, let's say that I'm buying the house for 100,000.
Yes.
And let's say that the rehab is 35,000. Okay. I can borrow in that example up to 75% of the 200,000 after repaired value amount. So in that case, I'd borrow 150,000 from the private lender. Private lender will wire the $150,000 to my real estate attorney's trust account because we don't accept any money directly ourselves from the private lender. Goes to the closing agent. So now the closing agent, the real estate attorney's got a wire for 150,000. Well, only 100,000 of that's going to be used for the purchase price.
Yeah.
So I'm going to get the difference when I buy. I'm going to get a check for $50,000 less closing cost. All right. On that deal. So I'm going to bring home a check for whatever, $49,000.
Yeah.
I'll use 35,000 of that 49,000 for the rehab. That leaves me an additional $14,000 any way I want to use it. Marketing cost, operating cost, carrying cost, right? I mean, this is a beautiful thing. Let's say that my private lender on that deal requires monthly payments. Well, initially, whose money am I using to make their monthly payments?
Their money.
I'm using their money to make their monthly payments, right? Now that money is going to run out. So I got to get that house, either rehabbed and sold, or I'm going to have to get it cash flowing, as quickly as possible. But I mean, you just can't beat the cash flow scenario of not having to pull the money out of your pocket. And I mean, it's a beautiful thing when it comes to the cash flow on those deals.
Absolutely.
Now let's take a look at the end of that deal, Sari.
Yeah.
Let's look at the end of that deal. So, my average profits right now are $71,000 because the median price here in our area is now above $250,000. So back to that same example, after repaired value, 200,000, bought it for 100, rehab 35.
Yes.
So now I got 135 in it, right?
Yes.
Now let's say I sell it for 200. Well, 200, I still owe the private lender 150,000.
Yes.
Right, at payoff. So let's look at the first check I got. The first check I got was $50,000, $49,000.
Yeah.
I'm going to use 35 of it for the rehab. That's leaving me 14,000 left over for whatever when I bought it. Now, when I sell it for 200, I still owe the private lender 150 because we either accrue interest only or we make interest only payments. So we're not paying down the principal. And that's a win-win for both the lender and the borrower. The lender makes more money by keeping all their money invested until cash out.
Yes.
And it helps our cash flow on interest only. So I sell it for 200. I still owe 150. Well, when I sold it for 200, I bring home a check for $50,000 less realtor fees. Right.
Okay.
So I paid 5% to the realtor. So I'm actually going to bring home a $40,000 check. So add the 40,000 less closing costs.
Yes.
So for easy computation, I'm going to take $40,000. I'm going to add that to the first $14,000 check. In that $200,000 example, I made $54,000 less carrying cost.
Yeah. And then zero done out of your own pocket.
And zero out of my own pocket. And that example also assumes that Murphy did not show up on the rehab. And you know who Murphy is, right?
Who?
Murphy lives in every house. The law of Murphy, if something can go wrong, it will go wrong, right? So, if Murphy don't show up too bad with unexpected overruns, we'll still end up with 54,000 less carrying cost.
Wow. And then you can even get more technical or more nerdy. If you imagine if you had like credit cards with like Home Depot or like other stores, you could probably use your credit for those stores, and then you have your capital still with that you opened up from the private money. So maybe that's, do you ever see that happen?
Oh, sure. I use
Yeah.
my Lowe's credit card all the time, right? And
Yeah.
so I can pay my credit card off either when I cash out on the deal, or
Yeah.
I can be paying it off monthly as I go. Because remember, I got the $35,000 up front for the rehab,
Yeah.
right?
Yeah.
So sure, absolutely.
Yeah, definitely. And then, okay, so what role do you play now with the private monies? Are you like a coach, a consultant? Walk us through that process.
So I wear two different hats,
Yeah.
right? So I continue to teach private lenders, new private lenders, how
Yeah.
they can be a private lender. I teach them about self-directed IRAs. So we're all the time having new private lenders come in.
Yeah.
And the other hat I wear is I teach other real estate investors how to do exactly what I do and how they can go raise their own private money as well.
Perfect. And how can listeners reach out to you and connect with you?
Well, the best way to reach out to me is for me to send them a copy of my new book, which is called Where to Get the Money Now,
Yeah.
subtitle, How and Where to Get Money for Your Real Estate Deals Without Relying on Traditional or Hard Money Lenders. And this book will walk your audience and listeners through the 5 easy steps of how I raised over $2 million in less than 90 days. So it's $20 on Amazon, but here on your show, it's free. If they'll just pay a couple of bucks to cover shipping, they can get this book and connect with me at www.jayconner, Jayconner. I'm an ER, not an OR. JAYCONNER.com/free book. jayconner.com/free book.
Perfect. And I'll add in all the notes and I'll add in the links in the show notes below. Yeah, Jay, thank you so much for joining us. I enjoyed our conversation. I look forward to having you back on the show.
Awesome, Sari. Thank you so much. I enjoyed being on here with you.
Thank you. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.